Crypto markets reject resistance levels and turn south as tariff uncertainty and stagflation fears weigh on risk assets ahead of Trump's Liberation Day. The options market sees a lot of put buying, which takes skew back into put premium across much of the curve. But with quarter end out the way and liquidity set to rise, is it time to buy the dip yet? All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larker from Options Insight. I've got my man Dave from FRNT, and today's special guest is Barnali Biswal, CEO of Hilbert Group. Welcome.
Thank you.
Good to have you on the show. So, Dave, we'll start with you. Markets, what do you think?
Do you know what? It's really difficult, isn't it? It's all about Liberation Day. I think Trump tariff uncertainties just kind of still dominating, driving everything. Overlaid with that is still this stagflation fears. We had a slightly stronger PCE inflation report on Friday, which kind of underpinning that softer spending data, weaker consumer confidence. So we've kind of, which is like the worst scenario for risk, right? Stagflation fears where you're worrying about recession or a sort of growth scare, but without the Fed being able to do anything because of the constraint of inflation. Now, again, I'm a little bit dismissive of that, partly because we had Jay Powell tell us that
we said it'd be transitory.
It'd be transitory, yeah, right? So,
use that magic word.
Yeah, and I'm still of the view that we're in this slowing, not collapsing, like growth environment. We had the S&P Global's PMIs on Friday or Thursday, which still look pretty good. We're still not seeing any. We'll get the labour market report on Friday, but we're still not. If you look at the jobless claims and what have you, there's no collapse in the labour market just yet. But again,
today's got a big number though, right? Not today, this week, non-farm payrolls.
Yeah, non-farm payrolls. So I think this week is really pivotal for a lot of narratives. Obviously, Liberation Day, will we get some clarity on that?
No.
Kind of feels like we're in like the sell the rumour, buy the news. I think there's a lot of bad news priced in. But again, that's what
the problem is. The market hates uncertainty, right? And the only way we're really going to materially rally off this is if the uncertainty gets lifted, and I just don't see it happening this quickly.
Yeah, I mean,
there's also seasonality, right? Like just U.S. tax season, crypto had always sort of Q1 seasonality.
Monday, yesterday was Japan financial year end as well. We've had quarter year end, which, as we've talked about before, negative liquidity, and you also just got like portfolio rebalancing, position adjustments. So I kind of think there was a lot of noise last week that people then start to backfit narratives to. But I guess the core theme is still this uncertainty around trade. Again, my kind of view on it is that we've priced a lot of bad news, and maybe through Q2 we start to get the compromise and all those sorts of headlines. And then as you mentioned at the start here, I still think the Fed was quite significant a couple of weeks ago. Jay Powell, from today we get the slowing of QT down to just $5 billion.
So liquidity, which apparently is a big driver for crypto, it should be turning in the right direction. Right?
Yeah, and they're certainly laying the groundwork to start providing liquidity to help with this maturity rollover. Be it slowing QT down with a recognition of concern around like reserve levels in the banking system and liquidity. Jay Powell, I think back in February in front of Congress, said about supporting this idea of removing or reducing the SLR exemption, the supplementary leverage ratio, to basically exclude treasuries from counting towards capital charges for banks, which will encourage banks to hold more treasuries. So they're certainly thinking about how we're going to fund this, and ultimately it leads to we're going to end up supplying more liquidity into the system. So I think liquidity polls picks up through Q2. Are the lows in? We'll see what Trump delivers, but I'm feeling pretty confident. How are you thinking on this market?
Yeah, I think much of what you said resonates with me as well. I would say structurally, everyone feels at a very, very good place in crypto market in general. But in terms of risk assets, there is clear weight due to the uncertainty, the policy uncertainty. And frankly, that is pretty fundamental in nature, right? Because, I mean, shifting substantially into a multipolar world where there could be a period of de-dollarization, that's a pretty significant change, and markets will take some time to adjust to that sort of new normal. So I think we are in that phase, and that's weighing on the short to medium term price action. But fundamentally, when you think about adoption, regulatory and policy changes, any kind of sort of external backdrop, that's very, very favorable for the crypto assets.
Yeah, for sure. I mean, certainly that you talk about that regime change, and I always think of Bitcoin as being like the ultimate hedge against, disruptions to the existing economic or political world order. Obviously, it feels like gold's taking the lead. Although I think I pissed a few people off like today just by highlighting the fact that since the election, Bitcoin has outperformed gold.
It doesn't feel like it.
It doesn't feel like it, yeah, because I guess we overshoot and then we correct and then it feels really bad. But here we are, 84K. It's
well, I'll tell you something that hasn't outperformed Ethereum, right? but I want to get more onto what you're doing over at Hilbert. So you started in credit at Goldman's, right?
Yes, I did. I had about 14 years of my career between the US and here in London prior to joining crypto. So most of my otherwise, I guess, professional career was in traditional credit markets, predominantly trading side of the things.
Okay, and then what made you kind of make that switch over to crypto? What drove that?
I don't know, midlife crisis, I think.
They do take many forms.
I would say that it was a different world pre-COVID. And at a certain point, you are obviously looking for the next thing for the next decade for your career. And I just happened to stumble onto the crypto side of the things because of a common friend, between the firm that I came in through to crypto and my Goldman world. So frankly, it was not at all planned, I would say. Okay. But I'm glad I did.
What's his like friends and family, colleagues?
Yeah, because how long ago was that?
This was just when we went into lockdown, first lockdown. So 2020 is when I left Goldman. 2021 or 2020 and 2021 middle is when I formally, I would say, came over to this industry. What did they say?
Yeah.
I mean, what do you think this? Up until I would say 6 months ago, I have had a lot of commiserations, concerns, and just flat out, what are you doing?
And then a year later, after you get involved, you had FTX happen, right?
Yes. Luna first, Terra Luna.
Yeah.
And FTX, but I come from credit. I mean,
there's no irony.
One thing you are trained in is like blow-ups, and especially, these dominoes that fall. Because Terra Luna was classic deleveraging, right? Like that went, then the whole Celsius, 3 arrows, all of that.
Got exposed. Yeah.
So, I mean, I don't think it was a shock to the system in terms of what was happening in the market, but I was very ambivalent as to what relevance does my skill set has or have had for the industry initially, because even though you have done certain amount of research, spoken to people in the industry, etc., I wasn't very clear what is the clear translation other than sort of managing assets and risks side of the things, which is one-to-one correspondence. But I think that 2021 events, that was clear indication to much of the market that crypto's underlying sort of risk is largely credit in nature. And being able to underwrite counterparties, operational and structural leverage is something that is of paramount importance, not just to asset allocators, but to risk managers and asset managers, etc. And I think I would not have come to that conclusion as fast as I did had the bad things not happened.
Right. But like, is there the transparency there that you need to make those informed decisions around the credit worthiness of various projects and tokens or whatever it may be?
I would say that it is substantially better than what we had in 2020 and 2021.
Okay.
But it could also be that, the whole asset class is very firmly in the emerging or emergent category, right? And their booms and busts are common occurrences. And during the time of mania/boom, you have very lax standards, and people are largely focused on the upside and very rarely worried about the downside. But fast forward to now, if you speak to even semi-sophisticated allocators into the space, from their underwriting processes to the types of disclosure and transparency that is available now from various institutions/counterparties, it's substantially better. Now, we're not at traditional market levels. That I would point that or attribute much of that lack to a lack of standardization, because there isn't a clear sort of must do and or must have when it comes to processes, disclosures, transparency, etc. And as the market matures and you have more and more sort of traditional allocators enter the space, you should see those demands being met by the market participants.
And being from credit, I guess your ideal scenario would be a functioning CDS market.
100%, because I mean, you could literally, all of us can sit here and talk about creditworthiness of XYZ, and we can literally take any name in the industry, and whether that's systemic, whether that's not, whether you should face it or you shouldn't. But at the end of the day, diversification is one thing, but the other thing is, what do you do about the risk? You may be able to ascertain the risk. You can even, to some extent, with the amount of information now available on-chain and off-chain, be able to quantify it because you have X amount of exposure to a certain credit trading counterparty, let's say. But then what? The best right now as a fund or an asset manager you're able to do is disclose that to your LP. We are unable to actually manage that risk or mitigate the risk. And that's also part of the reason why the sort of lending and subsequently insurance, all these other value chains, that value systems that exist along the chain have not developed within the crypto market as a space. And I do think it also begs the question, we've been here, whatever, decade, 2 decades almost. Why is it not there? A lot of it can be pinned to, again, the regulatory backdrop has been a big impediment. And for a lot of anything that relates to credit, in order to mitigate, you need some substantial balance sheet holding institution to be entering the market and taking the other side of that.
Like a big bank, like a Goldman's.
Whether that's a big bank, big insurers, but regulated and heavily monitored institutions in the traditional space. it doesn't have to be traditional, but none of the crypto, because of the fact that it is such a new market, you don't have that kind of balance sheet away from literally the exchanges, and even to that, the biggest of them.
But is that the big opportunity that banks have that is not already in the crypto market? Instead of trying to come in and basically steal the business of native crypto firms, why not just come in and create that CDS market? Because there isn't one.
But I mean, I would agree that there is a, on the demand side of it, there is a substantial need and a lot of focus. But in the absence of regulation and clear sort of blessing from various, especially US and EU as the jurisdiction, I don't see that happening.
But we've got the crypto president now.
And you would imagine this will be on the cards, but it just isn't here yet.
Right.
Yeah.
I do expect some M&A as well.
Yeah.
As things start to become clearer to them as to, it's green light.
I think, though, this is the point, right? And I mean, for all the excitement around sort of what this Trump administration's bringing, a friendly SEC, and they are kind of dialing back on some of, somewhat the Gensler SEC was doing to be more business friendly. We still need that regulatory framework, and it's just going to take time. It is going to take time, and it feels like we're working towards it. But again, if you're a bank or one of these big institutions, even if you're chomping at the bit to get involved in this space, it's like, we need that. We need to know what the rules of the game are before we can come in and do it. So I think once that drops, once the framework's in place, you'll see a lot of this come in. And then to your point, I mean, I think M&A is going to be, it feels like it's already a big kind of story this year. I think that's partly as well function. I think there's a lot of native firms in this space that raise that at probably
really high
valuations that they can't really justify. So I think certainly we're going to see and we are starting to see a lot of M&A type activity, a lot of consolidation in the space, and I do think like TradFi have been essentially persecuted by the SEC for so long that they're now got the trigger to get involved, and they've not got the expertise in house. So how long are you going to take to build that internally, or do you just go out and start buying businesses? And I think that's going to be quite a big theme over the coming sort of weeks, months, and a couple of years, I think.
And I remember you mentioned to me offline about prime brokerage in the space being quite far away from what it's like in TradFi.
Yeah.
That being one of the challenges that you face as like an allocator.
To your earlier question, Imran, it's not just CDS and not just like a protection buying mechanism, right? It's the entire stack, the trading pipes. That's still, we're substantially better off again. Pre-FTX, you have Clearloop as one of the solutions. That's an off-exchange settlement. You can also, even though it's not widely popular yet or standardized, but tri-party solutions are more and more popular. But it is all band-aid solutions. Typically, a trading house goes to one or two prime brokers because that is the counterparty exposure that you are taking in the traditional markets. The PB turns around and not just provides not just holds your asset or provides margins and cross-margining and all of that. They also do execution. It's an end-to-end solution for a hedge fund in a TradFi world. That structure does not exist in that form or in a very UX-friendly format in crypto.
Yeah, and it's very fragmented as well, right?
Yes.
Which is a huge problem in terms of the efficiencies that a PB typically brings.
Yeah, and also we still have much of crypto because it's built still by individual silos. You have some ability to speak to different systems. But beyond custody and exchanges, trying to get other parts of the trading ecosystem to talk to each other is still clunky.
Yeah. So what is it? So tell us about Hilbert Group and all the sort of things you're doing there.
Yeah, so we are basically a crypto firm. Two of our bigger operations or main operations, one is the asset management, Hilbert Capital. That's a regular hedge fund. We're focused on quantitative strategies largely. And we have been on that side. Probably, I don't think we are the longest track record, but certainly one of the longer running hedge funds on that side since, I believe, 2018. And on the other side, we own, we're the majority owner of a business called Coin360, which is a data and analytics platform. And therein, we have invested substantial amount of time, money, and effort last year revamping the product and creating a robust ecosystem on which further RWA DeFi related projects can be built upon. So that's more sort of Web3 and crypto infra side of the things. But if you think about it, they're quite synergistic in nature because, one sort of drives traffic and lets us have a lens into where the buck is going, proverbially speaking. And the other side can glean from the fact that the demand / the ecosystem has certain type of need and how we can best serve our investors through either of these side of the businesses.
And the hedge fund is doing Delta One quant strategies or using optionality as well?
No, we have a number of strategies therein, but largely the way I would frame them is they are non-beta in nature. So either
market neutral.
They're not quite market neutral, but I would say delta neutral.
Okay.
But the overarching theme would be to dampen the vol, especially of the return distribution to the LP. So these are strategies. They would have anywhere from, let's say, 10 to 30% annual return targets with circa 7 to 15% annualized vol kind of parameter. Now that varies within various strategies, but roughly those are the parameters. And we trade spot, perps, as well as options. So it sort of depends. And the two sort of main focuses, one is the multi-strat fund that we just launched 1st of April. And that essentially takes all of Hilbert's previous DNA and takes the stronger, better version of those. And we just completed the acquisition of another asset manager out of Monaco called Liberty Road. They brought an additional set of alpha engines that are very complementary, decorrelated from Hilbert's own previous in-house products. And we have now combined a variety of routines underneath the multi-strat with a view that over time we can add, subtract, and sort of remain nimble depending upon market conditions. And then away from that, we are also in partnership with Xapo Bank, and we are the investment manager for the Xapo's credit fund. And that is a purely Bitcoin-denominated lending vehicle that is targeted towards providing yield to, obviously, Bitcoin holders in a manner that's very institutional grade. Within Xapo's ecosystem, which is obviously highly respected by the Bitcoin community and brings all of Hilbert's institutional infrastructure when it comes to the regulatory side of the things, the fund structures, operations, and focus on risk management. So there are several things inside Hilbert Capital currently going on.
Nice. So something I want to pick your brains on. I mean, me and Dave have thrown this around a little bit in previous episodes, but the MicroStrategy trade, right? So everyone,
we're going there.
And because we're going there because you come from a credit background as well. So I'd like to get your insights. But basically, there's a lot of people out there claiming it's a bit of a Ponzi. There's some people saying he's a genius. He's arbitraging the financial system. Like, what's your take on it?
It's a tradable asset. There are some sellers, clearly Ponzi, some buyers. to the trader in me, there's a bid and an ask.
There's certainly been. He seems to be one of the big bids on Bitcoin. Like whenever Bitcoin's going down, you hear it hit the tape. Oh, he's just bought another few billion of Bitcoin, trying to hold it up. But like, it does make you worry. The way the capital is being raised to then just go and buy more Bitcoin, and the people coming in each new tranche of capital. It feels like if they just invest directly into Bitcoin, they're getting much more participation. So is there not some sort of question marks around the way that is happening?
Yeah, so this is an interesting question, and I'm not firmly in either of the camps when it comes to whether it's completely a fraud or it is the greatest thing ever. To me, this sounds like taking advantage in a creative capital structure management / financial engineering sort of way to harvest the volatility of the underlying asset. It gives the vol itself is so elevated that it gives certain cheap optionality to a CEO, which is Saylor, in managing his cap structure. From the investor side of the things, the way I think about it, now that I've sat on the crypto seat for a while, if you're just a pure MicroStrategy convert / stock guy, this to put it in crypto parlance, this is sort of like the altcoin of the stock world. In credit, you would have very highly levered and highly risky balance sheets that may over time, for various reasons, migrate either towards bankruptcy or towards investment grade. That's not abnormal, right? But understanding that there is inherent structural sort of leverage is the right word, but there is it's like leverage squared in some sense. In there, it kind of lets you then frame what is the compensation for that type of risk, because the job of an investor is then to assert whether they are being compensated for the type of risk that they are taking on. So in my view, that's a creative way to manage the cap stack, but in some sense not dilute, but have a free purchasing power in an asset that a certain individual / the institution's board believes in. But I'm not necessarily anti or for it.
The point you made to me offline as well about, because I was confused as well, like why would you buy MicroStrategy when you can just buy the ETFs on BTC?
Yes, but this is an interesting point, right? Like, because pre-ETF, there was no real, there was a slew of traditional investors or allocators that they're not sleeping on the wheels. Not all of these guys are just, a lot of crypto seem to think they're just dumb, or no, it's just not within their mandate.
That's right.
And there wasn't any regulated is the word that I would emphasize on, way for them to get that exposure. Now, ETF does bring a beta exposure to it, But if you think about from the convert side of the instrument side of the things, a lot of traditional investors like the optionality of sort of like 50% whatever premium that they'll get upon conversion, right? So there is a familiarity and a less stigma in owning it. Even now, I mean, like if you are some of the names that is on their cap table, like State Street and a couple others, whatever. I mean, if you are the CIO of one of those organizations, to then file saying you own X% of 30, like Bitcoin or Bitcoin ETF, even, it's much harder hurdle compared to, part of your stock portfolio. It's just
you don't have
easier.
You don't have to highlight it as much as in we're saying is
it's more acceptable in a sort of like low job risk sort of way.
I suppose that's changing now, though, right? Everyone wants to get into crypto now, so that the career risk is going away.
I mean, we would like to think so, but if you talk to TradFi, they're never in a rush. When you
that's because it's not going up though. The minute it goes back up above 100K, they'll all be in a rush again.
I think people are, institutions are less so.
Sure.
Because I mean,
chart chasing. Yeah.
I feel like when you own a big pot of, money, you own a lot of like control over your entry terms, your terms of sort of building and scaling, that they can afford to be late. There is very little downside of not being first here. So I mean, that is not to say they're not coming. I am personally very positive, and we're probably seeing the best in the existence of crypto sort of environment where institutions will be more motivated than they ever had been in the past. But I'm just saying that the expectation tend to overshoot. Always, it seems. And it typically takes some time for these organizations to get their act together and go through their processes and committees and whatever else.
I always say, like the Bill Gates quote around people tend to overestimate what they'll achieve in 1 year and underestimate what they'll achieve in 10.
Yeah.
And I think that captures sort of where we are in crypto perfectly. I do think as well, and present company included, like I think the people I know moving from TradFi into this space tend to be a little bit more entrepreneurial, have that kind of entrepreneurial itch, even if we go and work for other companies. There's a lot in the traditional space that I say, they're clipping coupons, right? They're getting paid really well. They're not, why rock the boat unless you've really got that urge to sort of do something different. But eventually that decision gets taken out of their hands. They get told, right now we have to be in it. But yeah, it's still very slow. I mean, I still, I put out things on social media and I still get pushback from people like basically like just by talking about Bitcoin, I'm talking about some Ponzi that's worthless, and I'm like, we're still at that point. Okay, right, we there's still a lot of education to be done, but the money talks at the end of the day, and I think you think of some of these fixed businesses like the fixed income, commodities, currency businesses in banks, suffering from massive margin compression. I mean, they've probably done well over the last few years because we've had sort of volatility, but driven by these rate differentials. But those businesses are struggling, highly commoditized, and eventually they start going, where's the growth? And the banks that and the traditional businesses that take the lead in this space, and that's driving all their growth and their revenue growth. All of a sudden, then everyone's going, right, we have to now be in it. And I think we're kind of maybe nearing that stage. And
it's interesting as well because, so many of the people we talk to on this show who are coming from a TradFi background, who are running kind of proper institutional businesses within the space, even if they're allocating capital, they're doing it in a more market neutral way. They're not all just sitting there going like long number go up type thing. That's
what's the upside of that, right?
Yeah.
Like, I mean, at the end of the day, they are. If you wanted to invest in that manner, the many organizations are invested via VC or sort of like private equity type of way, where it's 0 or 100x. and then they don't have to look at it. It's not mark to market. But the moment you're actively managed, you have like a P&L, then, it's very hard for a CIO to then take on like the vol that's embedded in this asset class right now.
And the volley is coming lower, but yeah, it's still pretty volatile, right? I mean, especially when you look outside of Bitcoin, I think Bitcoin's realizing like 35, but Ethereum's consistently realizing 20 vols above that, right? So still almost a 60 vol asset, which makes it quite hard to kind of take a lot of beta risk, like you say.
Yeah, and that's in a calm market. I mean,
that's right. Yeah,
we haven't really seen a pullback, even post this recent S&P and Nasdaq drawdown, but it's in the scheme of things pretty small.
Yeah.
It's funny. I love this. Anyone who's been in this space a while is so relaxed about. Yeah, I mean, I think those who are deep in the alt space are obviously suffering like a quite a heavy drawdown. But in terms of Bitcoin, it just feels very normal, right?
One thing that spooked me a little bit looking at the options market this week was that there has been a consistent bid for calls over puts in the back end of the curve. So anytime we've had like weakness in spot, it's all short term that the put demand comes in, right? But you've always seen very much, good like 4 vols of call premium in the back end of the curve. Finally, that is starting to get pushed down, right? It hasn't flipped to puts just yet, but it's getting frighteningly close, right? And like the inflection point where it goes from put premium to call premium might have been like 1 or 2 months out before. Now you've got to go all the way to September to see a call premium come back into the skew. So it's kind of like the option market saying this weakness could persist a while, right? We're not getting out of it that easy, basically. So something to watch out for.
What side of the equations, right? Like, is it like put demand further out or selling of sort of call structures?
I think it's probably more selling of call structures in the long end. So people not as excited about piling into the upside.
Yeah.
And then in the front end, that's where people really, if they need to buy puts, they usually want to buy short dated puts. Right?
Yeah.
Yeah.
So everyone spooks, even the long term bulls.
The options curve. Yeah.
So what you're saying is absolutely. I mean, the same thing that we have witnessed as well, and I do agree that it does more than sort of like down drift. It feels like we're probably still stuck in some kind of range, especially near to intermediate term. But what it does also tell you is that there isn't a lot of leverage in the system, meaning people aren't like every single time you hear X whatever percent liquidate or whatever million liquidated in the last 24 hours, etc. It's typically like non-sophisticated, non-institutional flow, but on the actual sort of like money manager, traders, sophisticated investors balance sheet, that's not levered. And that is in fact reflective of what we have been speaking about. People are cautious for obviously the fact that there was a lot of good news built in going into Trump presidency or January, I guess. And then since then, there has been a sort of more moderation in expectations of when all of these regulations will actually come, and any deregulation when it comes to banks and ability to access to banking services, etc. All of these things are now kind of much more at a reasonable space when it comes to expectations. So that has, in my opinion, made a lot of risk takers pause until the chips fall on the table and then make their move. So books actually look pretty clean.
Yeah,
I mean that's the street.
That's why I mean I generally kind of have a more sort of bullish tilt to my outlook in a way, and I feel what's gone on over the last call it last quarter really. There's just been this like degrossing and de-risking of books that brings kind of all asset classes down with it, but like part of the like bullishness, even as we go into Q2, is as you start to get some certainty, the re-risking, the re-leveraging process just means things go up, right? And now obviously there'll be sectors that outperform, but generally money gets like put to work. It reminds me of during like COVID, and at the time sat on an FX trading desk, and the world was kind of ending, and for a couple of weeks it felt that way. But then I started to get bullish when I'm talking to asset managers who you still might be going, particularly say in emerging markets where you're like surely this still looks really bad, and they're like, yeah, but we're as underweight as we can possibly be, like within our mandates. We can't be any more underweight. So the only way we go from here is to actually like buy back into it. We can't be any more underweight than we are. So there's kind of these like kind of I guess kind of structural mandated sort of ways in terms of portfolios have to be allocated. So once you've grossed down risk, managers charging 2 and 20 or whatever for exposure to an asset class. There's only a certain amount you can kind of sort of deleverage on that, and it'll be the same for sort of crypto. So I kind of feel like we're going to see some kind of re-leveraging into Q2 on the assumption we get some sort of clarity on how this is all going to play out, which given you think that we will find. But like all the conversations I've had, even certainly over the past week, is we're all kind of going through this scenario analysis of what if this, what if that, but no one really knows, and we're all playing a guessing game. A guessing game around probably one of the most volatile guys on the planet, who happens to be
leader of the free world.
So we kind of just have to wait and see. But I'm kind of that view that I'm still like a rates liquidity dominate everything, and the Fed are kind of laying that ground for liquidity to come back in, and it won't take a lot of certainty to kind of spark those animal spirits to get back into this market and start having exposure to something.
Well, what about you, Barnali? Anything you want to leave us with today to end the discussion?
No, but this has been very, very productive discussion, I would say, and quite balanced. I just think we are all in a marathon, and it's not a sprint. And every now and then it takes some reflection to kind of accept markets will go through ups and downs and periods of just absolutely nothing, which is kind of what we are in right now. But I concur with David that over a longer horizon, this is probably the best setup we have seen in this market, like bar none. So, it's about survival.
Strong words.
That's the clip. That's the clip.
That's good. I'm definitely going to be putting that on my Twitter tomorrow. All right, strong words. Thank you so much for coming on the show. It's been an absolute pleasure having you on.
Thank you very much. Thanks for the opportunity.
And we will remember, like and subscribe, and we will catch you all next week. Cheers.